Takes us to our talk of the tape. What the last month of the year could bring for stocks. Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth. She's here with me at Post 9 once again. Nice to see you again. Hope you had a great Thanksgiving. Okay, so we're about to put a great month in the books. What's it mean for where we go from here? We have a lot of momentum, it feels like.
Yeah, I mean, I think that a little bit of digestion wouldn't be unsurprising, kind of like what we're seeing today. Markets did get overbought last week when we look at things like RSIs, but we saw breadth improve a lot, things like 20-day highs, percentage of names trading above their 50-day moving average. That's supportive of further room upside in this market, at least through the end of the year. And that's kind of where we've been thinking about it in two distinct phases is, yeah, we can rally through the end of the year, and then let's take a really sober assessment at the start of the year to set expectations for where we could go in 24.
So this is all just what? Positioning, trying to get ready for, the very end of the year, but we're still not willing to go out on a limb and suggest, hey, we think we can get a soft landing. We think that earnings are going to hold up to the degree that the market thinks. Inflation is going to come down, so we should be a little more bullish than maybe we are.
It seems like that is what we're now pricing in. If we look at 19 times earnings on earnings growing 12%, that's the soft landing. 19 times supported by a Fed, that's a bit easier. 12% growth supported by economy that does not have a recession. So positioning really is the key kind of driver here of flipping even more positive, meaning that as people get drawn back into the market, that's where you could see the market trade up closer to 20 times, which is back near prior peaks and valuations.
Feels like, maybe you have a few more bulls than you did a couple of months ago. I mean, a good trend will do that. Brian Belsky was on the halftime earlier today. He's bullish. 5,100 base case, 5,500 bull case. Here's what he said as to how we can get there. Listen.
We see a really rapid drop-off in inflation. We see earnings just take off, and GDP holds in there a little bit better than we thought. And so I think from a 5,100 number, that's for our 5,500 number. For our 5,100 number, which is our base case, inflation rolls over, recession in name only, not a technical recession. Rates stick around 4% for the first half of the year, dip below 4% the second half of the year. The market broadens out. We're going to be in a market where you should own both growth and value. And in terms of size and style, I like to call it the Jackie Moon market. Own everything. Equal weight everything. Don't be massively over large. Don't be massively over small. Own a combination.
Now, there's a lot in there that you could pick at if you're not quite as bullish as Brian is. First and foremost, this rapid drop-off in inflation, earnings taking off, in his words, and GDP holding in there better than we thought. Is he too bullish?
If you take the 5,100 and break it apart, what you're essentially saying is that by the end of the year, when we look at 2025 earnings, we'll be growing earnings about 10% next year, 10% again in 2025. You'd be then at $270 a share-ish. That would be 19 times at 5,100. That's still an expensive multiple, which means that you do need interest rates to come down. You do need inflation to come down in order to get there.
Well, that's a big part of how he thinks you're going to get there. Do you think it's far-fetched?
I don't think that interest rates will fall as much if the economy remains so robust. That would support an earnings output that would be that 10% growth each and every year in 24 and 25.
So in terms of what else he said, market broadens out, should own both growth and value, own everything, and equal weight everything.
And I think that saying own everything else, because there's so many names that have been left behind this year that if you look at the equal weight index, it's trading at about 15 times. It traded at 18 times back in 2018, 2019. There's opportunity in a lot of parts of this market, which just means that it's more of, and I hate to call it the stock pickers market, but there's more dispersion we're seeing within sectors, meaning that just looking at one sector isn't enough.
The breadth has gotten better lately, right? I mean, it's not all been top heavy over this last great stretch. Is that a sign that we're going to have more mean reversion? We're going to get other areas of the market to start performing better?
It's an encouraging sign. And what we'd like to see is better relative performance, because the thing that's been troubling is that if you look at both cyclicals and defensives, they're actually still in relative downtrends versus the market, which just means that it still is so tech heavy. There is still only one horse in town, and it's tech.